Welcome to the seventh episode of Talks with Daulat. My name is Akshita Maheshwari and I am the content and growth lead here at Daulat. Today we have with us Varun Fatehpuria, the founder and CEO of Daulat. Before Daulat, Varun worked with some of the biggest investment institutions in the world like Bloomberg and Blackstone. He also graduated with distinction in finance and information systems from Hong Kong University of Science and Technology. He is also a NSIM certified investment advisor. We are glad to have you here with us, Varun.
Thanks for having me, Akshita, once again today.
Daulat is a tech enabled, all in one platform that provides customized portfolios for you to reach your financial goals. Today, we are here to discuss another interesting financial topic, which is target maturity funds. So, Varun, before we go into that, could you please explain what is meant by a debt mutual fund?
So before we understand what a target maturity funds is, we really need to have an understanding and a quick recap of what are debt mutual funds. So debt mutual funds are a type of mutual funds which invest in fixed income securities like bonds, non-convertible debentures, commercial papers, certificate of deposits, etc. Let's say, for example, today you have 10,000 rupees to invest. Number one, today you could either go and invest or subscribe to a bond issued by a single issuer. So that could be a central government, a state government bond, or a corporate bond. Or you could go and invest this money in a debt mutual fund, which will then further invest in a much broader and a wider pool of fixed income securities. So there are two key, I would say, advantages of investing in a debt mutual fund as opposed to buying individual bonds. Number one, you get the benefit of diversification. And since you are invested in a much broader and a wider pool of fixed income securities, as opposed to being concentrated in a single bond issued by a single issuer. And number two, you get the benefit of expertise of a professional fund manager, since these fund managers and fund houses have the expertise and the know-how and the skill set of selecting these instruments, which sometimes could be really difficult for an individual investor to get their head around. So these are the two benefits that you get by investing in a debt mutual fund, and that is how it is different from investing in a single bond.
What are some risks that are associated with investing in a debt mutual fund?
So whenever typically people invest in a debt instrument, they do not associate that with taking any sort of a risk. But when you're investing in a debt mutual fund, there are two key risks which you should be aware of. Number one is the credit risk. Credit risk is simply the risk that the issuer or the company will fail to pay its principal or interest on time. And that is really determined by the credit rating that is assigned to every instrument and every issuer. So today, credit ratings are on a scale from C to AAA, AAA being the highest and assuming the least amount of credit risk. So any of the government securities or the bonds issued by blue chip companies like TCS, Tata, or PSUs are AAA rated, carrying the least amount of credit risk. So the risk that it will not pay its principal or interest on time is pretty much negligible. The moment you start coming down below AAA, AA, single A, triple B, the credit risk increases with every step. And so to compensate for that, all of these instruments which have a credit rating below AAA and every step below that tends to pay a higher coupon to compensate the investor for the assumed higher risk that he or she is assuming. So that's number one, credit risk. And number two is the interest rate risk. Interest rate risk is the risk that arises from fluctuations in the interest rate in the economy. And when I say the interest rate, it is typically referenced to the repo rate by the RBI. And repo rate is effectively the rate at which the Reserve Bank of India, the central bank of our country, lends money to all the commercial institutions today, right? So let's say, for example, today you're holding a bond which pays a predetermined coupon of 8%. And that is something the bond or any of the fixed income instrument will continue to pay irrespective of the prevailing interest rate in the economy. Now, let's say in the next couple of months, the interest rates in the economy starts to drop, right? Suddenly, this instrument that you're holding, something which pays 8%, becomes a lot more attractive. So naturally, the price of the bond will shoot up. So similarly, how equity instruments are actually traded on the stock exchange, even bonds are also traded. So that's something that you need to keep in mind. And you also need to keep in mind the inverse relationship that interest rates have with the price of the bond. So typically, when interest rates rise, the price of the bonds fall, and when interest rates drop, the prices of the bonds rise. So these are the two key risks, the credit risk and the interest rate risk, that you should be aware of whenever you are investing in a debt mutual fund. Today in our country, there are approximately 16 different kind of debt mutual funds, which are characterized by the duration of the instruments that it is carrying. And that's something that we'll cover a little later on in our video. And you will see how a target maturity fund then effectively gets rid of both of those risks.
All right. So my next question to you would be exactly that. What is meant by target maturity funds?
So to explain you what a target maturity fund is and what are some of the benefits of investing in a target maturity fund, we need to understand what exactly it is first, right? So just to give a definition, target maturity fund is an open-ended indexed debt mutual fund which predominantly invest in government securities, state development loans, and AAA rated papers issued by the biggest corporates in our country. It effectively is investing in securities which are part of an underlying index. So similar to, let's say, if you invest in a Nifty 50, which tracks India's 50 biggest companies and is based on an underlying index, target maturity funds also work in a similar manner, that there is an index which is created by an index provider, and the target maturity funds only role is to solely replicate the securities which are included in the index. And today in our country, mostly all of these indexes comprise of the best instruments. Number one, which does not carry any sort of a credit risk, right? So that is something that I talked about, how a target maturity fund effectively counters the credit risk by investing only in the most secure companies, the most secure assets, like a government or a state bond, right? And number two, whenever you're investing in a target maturity fund, you will always see a specific year which is suffixed after its name, right? So today, let's say if you go on to Google and you type target maturity fund, you will see a whole host of options with different years after the name of that fund. It could be 2026, 2027, 2030. What that year effectively denotes is that any of the instruments which are a part of the fund are going to mature in and around that date. So the target maturity fund here is also not taking any sort of a interest rate risk, which I just talked about, the risk which arises from fluctuations in the interest rate in the economy. So if you as an investor today will hold on to that fund till its maturity date, number one, you will not have any sort of a credit risk. And number two, you will also not be, I would say, uh, exposed to any interest rate risk, which can arise in the interim through the holding of the fund. But if you stay invested throughout the maturity and only if you redeem it at the maturity period, whatever the year is, you are also getting rid of the interest rate risk, which is inherent in a lot of the fixed income instruments. So these are the two key benefits of investing in a target maturity funds, because it gives you a predictability of the returns, right? Today, a lot of the investors want to invest in a fixed deposit in a bank or an NBFC, because they have a very high visibility of return. They know that if they invest 1 lakh rupees today at a 7% rate of interest, they will get an X amount of money after 3 years, 5 years, depending on what the maturity period and maturity value is. But that is typically not the case with a debt mutual fund. And that is where a target maturity fund really comes into the picture, by getting rid of the interest rate risk and credit risk and providing you with a very high visibility of returns if you stay invested throughout the maturity period.
All right. Now that we've understood the benefits of TMFs, are there also any risks associated with investing in target maturity funds?
So the only risk that is associated with investing in a target maturity fund is something called as a reinvestment risk. Let me explain that to you with an example. Reinvestment risk is simply the risk that the coupons which are received by the fund will not be reinvested at the same yield of the fund house, right? So let me give you an example. Let's say if a specific bond today is paying an interest of 8%, that's a predetermined coupon that the bond will continue to pay irrespective of the interest rate in the economy. But let's say throughout the life of the fund, the interest rates in the economy start to drop, right? The fund will continue to receive that 8% coupon every quarter or every semi-annually or every annually, right? But that coupon also needs to be reinvested somewhere, right? And if the interest rates in the economy start to drop, if let's say today we are sitting at an interest rate of 6%, but if the bond is paying a coupon of 8%, you will probably not be able to reinvest the coupon, the 8% coupon that you're receiving at the same 8% because the interest rates have now dropped to 6%. So that is the only risk which a lot of these target maturity funds face. But the actual impact on the returns that you will be able to generate by staying throughout the entirety of the fund is minimal. Today, there will not be an impact of more than 10 to 20 basis points, which is 0.1 to 0.2% on your overall returns due to this reinvestment risk. So yes, there is a certain amount of risk which is inherent with investing in a target maturity fund by something called as a reinvestment risk, but the impact on returns tends to be very minimal.
All right, got it. So how does this compare to, putting money in an FD, for example?
So Indians love FD, right? I mean, today, if you just walk around, you will probably find a lot of people having their entire financial assets invested in an FD, whether that's with a private sector bank or a public sector bank, that's irrespective. But people love FD because it provides them with a very predictable return and they know that their investment amount is safe, right? But there are two key disadvantages that FDs have, or rather, let's say, if I want to put it another way, two advantages which target maturity funds have or any other debt mutual fund have over an FD. Number one, the interest income that you earn on FD, irrespective of whether the interest is something that you actually receive in the form of a cash in your bank account, is added to your taxable income every year and taxed at whatever tax slab that you are taxed at. So let's say if an FD is paying you a monthly or a yearly assumed interest of 10,000 rupees, but the maturity period of that FD is 5 years, and you will get that entire principal and interest at the end of 5 years. That 10,000 rupees that is accumulated interest at the end of every year is still added to your income and taxed at whatever tax slab that you're taxed at. But that is not the case with investing in a debt mutual fund or a target maturity fund because the tax liability only comes at the time of redemption. So if you hold on to a fund for 3 years, 5 years, 7 years, during that entire period, so long as you're not redeeming the fund, you will not have any sort of a tax liability or a tax incidence on you. That's number one. And number two, where debt mutual funds and target maturity funds win over significantly a fixed deposit is in the post-tax returns. So just like we talked about earlier, the interest income is added to your tax slab and taxed at your marginal tax slab. That is not the case with a debt mutual fund where the returns are taxed at 20% post indexation if you hold on to the instruments for greater than 3 years. So indexation is effectively just adjusting the cost of purchase to inflation, right? So after adjusting that, the effective tax rate comes up to about 13%, 14%. But in the case of an FD, if you are at the highest tax slab, you could be taxed as high as 35%, right? So the post-tax returns on a debt mutual fund or a target maturity fund is significantly higher than a fixed deposit.
All right, got it. So when exactly would be, a good time to invest in a target maturity fund?
So target maturity funds, just like how I talked about, have a specific maturity date. So today we are sitting in 2023. A target maturity fund could come up and then invest in bonds which mature in 4 years, 5 years, 6 years down the line. Today we know we are almost at the end of a rate hike cycle, right? Today a 10-year government security yields approximately 7.5%. And in the past year and a half, the RBI has raised the repo rate by approximately 250 basis points or 2.5%. We are probably expecting another 25 basis points of rate hike depending on how the world economy moves on. But more or less, the consensus is that we will not have a rate hike greater than that, right? So this is a perfect time for you to be investing in a target maturity fund and then locking in your yields, right? So today, if any of the fund which opens up for subscription, having a maturity period of 3 years, 5 years, 7 years down the line, are investing in securities which are paying a higher coupon up at about 7.5, 7.7%. The moment the rate starts to drop, you will also in tandem see a significant drop in the coupon or the rates of the instruments that are being issued. So in a rising interest rate environment or at a time when the interest rate cycle seems to have peaked, seems to be the perfect time to be investing in a target maturity fund by locking in the yields at this point in time.
All right, got it. Varun, my last question to you is if you could quickly summarize some key points that we should keep in mind while we're investing in a debt mutual fund or a target maturity fund.
So there are a couple of points that you should be really aware of when you're investing in a debt mutual fund. Number one, be aware of the two major risks, the interest rate risk and the credit risk. Credit risk is simply the risk that an issuer will fail to pay its principal or interest on time. And interest rate risk is the risk that arises from fluctuations in the interest rate in the economy. And both of these risks play a major factor in determining the returns that you are able to generate by investing in a debt mutual fund. Number two, when you're investing in a target maturity fund, always try to align your investment with the maturity of the fund. Let's say if you have a goal which is coming up in the next 5 years, try and identify target maturity funds which also mature in and around that time, because that has two benefits. Number one, it has a defined maturity. It exactly matures at a time when you require the money. And number two, it gives you a very high predictability and visibility into the return. So if you're investing in a target maturity fund with a yield to maturity of approximately 7.5 to 7.7% today, you could more or less be assured that at the end of 5 years, you'll be able to generate that return minus the expense ratio of that fund, right? So these are the two key points that you should be aware of when you're investing in a target maturity fund. Number one, the maturity date, and number two, the visibility of returns by investing through that period.
All right. Thank you so much, Varun. I definitely found this session very insightful, and I hope so did our audience. I'll see you next week.
Thank you so much again, Akshita, for your time.